Remember, we are all in this to make money. The idea of a capital stack is for you to properly arrange your deal in such a way that it will be beneficial to you and also to your investors. Capital stack is very important that you look at it and don't just be distracted because the numbers look good. You also need to look at other factors and be sure that this is good for you. So I'm going to show you a thought scenario. In this thought scenario, I have the senior lender, I have the mezzanine, and I have the preferred equity partners. And I also have the common partners. So the preferred equity partners are third party, maybe private lenders. I called them in, maybe I was not able to raise the entire money. I decided to reach out to the preferred equity partners to give me more money. This is how that will look like. So I'm going to give you another different scenario. This scenario is slightly different from the other one. In this one, I have an assumable loan. I also have a supplemental loan. So the assumable loan on this is 9.5 million. And I have a supplemental of 1.6. And the total of it is going to give me about almost 70% LTV, which is about 11.2 million. So the blended rate of both, let's say, is about 4.9%. So in this box, you are saying, like I said, this scenario is slightly different, and the reason why it's different is because this underwriting, this SDA, does not give us the opportunity to model 4 different kinds of capital stack. So we did some little alterations on it for us to be able to achieve that. This is quite different from the other 3 I shared with you. So in this case, I have the first position and the second position all in one place as blended with the interest rate of 4.9, both of them at a blended interest. When I mean blended, it means that the average of both is going to give me the interest rate. So the average of 2 of them is about 4.90. There's a formula for that, but I'm not going to go through all that. So it's not the typical average. It's a different formula to get the blended rate of the interest rate if you are trying to do a senior mortgage and a secondary mortgage. So for the purpose of this webinar, I'm going to just tell you that both of them, we are going to assume that the senior and the supplemental are all in this bucket, 11.2 million. And the blended interest rate is 4.9 million. So based on that, that means my raise is still going to be about 6.9 million. But in this case, that means my rate is still relatively high. It's about 6.8 million, but I'm like, 6.8 million is too much for me to raise. I need to get a partner, a private equity partner that can help me out. So I can decide to reach out to a private equity or a family office, people to cut me some check. And they said, okay, I'm going to give you 2 million. So let's assume they give me 2 million, right? And they're saying that the interest rate of this is going to be about 14%. Because like I told you, as you move higher in the pyramid of a capital stack, the interest rate goes up. So preferred equity partners are between 14 to 18%, depending on the people you are meeting. For the purpose of this, I'm going to assume a 14%. So after meeting my preferred equity partners, they said this deal is 14%, but we can arrange it in 2 ways for you. You pay us half of it on a monthly basis and the other half of it as pref returns. That is, you can defer it and be giving it to us every year. If that is the arrangement I have with them, so if the total is 14%, that means half of it will be 7%. That means they want me to pay them 7% on a monthly basis, and the other 7% of 2 million, defer it, to be paying it to them once a year. So this has changed the dynamics of the entire capital stack. So if this is the case, that means I'm going to be giving them 7%. I'm going to be giving the senior lender some percentage. I'm going to be giving them, for the mezzanine, some percentage. I'm also going to be giving the preferred equity partner 7% monthly. So my monthly payment is going to come in 3 tranches. I'm going to pay 3 different people. Then for my pref, I'm going to pay 2 different people. And who are the 2 different people? This same preferred lender. The other 7% of his 14%, I'm going to pay him. And remember, I promised my LP members 7%. So that means I have 2 preferred returns to give to both the preferred lender and to my LP lender. Imagine what that will do to you as a GP. That means it's going to be zero cash flow. That means you are making money for other people to enjoy. Although the deal is going to look very, very good. It's going to look more attractive to your investors. But for you as a GP member, it's going to be terrible. And also to your LP members, it's going to be terrible because you remember you have the preferred lender to also fulfill an obligation to. And they are also priority as well as your LP. They are also priority. So that might be a challenge. So let's see the implication of this. There's a caveat on this. We've tampered with this underwriting to help it function to what I'm saying. So this is not your typical SDA. So some things have been done for us to see the implication of what that will look like. So if I go to the returns tab for this, you look at it here, you see the deal looks very attractive. I'm having an average cash on cash of 7.81%. The multiple is about 2.15%. My IRR is 18.56%. If you look at this, you say this is a fantastic deal. I'm happy, everybody is happy, but guess what? When you go to the P&L slot of it, this is where you know that this is really bad for even your limited partners. In this scenario, my cash flow here is about 345. So after I did everything I did, I only made a profit in year one for 345,000. And I owe a preferred equity partner 7% of that. And I still owe my LP partner another 7% of that. And if I do that, that means I'm going to have a deficit of 49,723 in year one. It means that I'm at a negative. That means there is no GP split. I'm not going to get peanuts, and my LPs will not get anything. And even my LPs will not get their complete preferred returns. The only person that is going to go home smiling is the senior lender, the mezzanine lender, and the preferred equity lender. Those three are going to go home with complete money. But my LP's pref will not be complete. I'll have to defer it to the next year. And me and the GP, nothing. And as well as the LP, no cash flow. They will not have a single dime. The same thing in year two. Year two, I made a little more profit. I made about 446,000. And in that 446,000, I paid part of it to my LP, to my preferred lender. And I also paid majority of it, including the one I was owing my LP for last year. I paid them, but I still had an outstanding amount of this. But if you look at my GP, nothing. I have nothing. And this thing continues to the third year. In my third year, I was able to make a little cash flow. In my fourth year, a little cash flow, and on and on and on and on. So if you as a GP are not patient, you might be pushed to sell the deal because there's nothing motivating you to do it. It feels like you are working for people to enjoy. So this is why you see that some deals are not mature, and you see some sponsors selling or deciding to exit or refinancing when the property has not even achieved the value. The average time for your property to reach that peak is typically between 3 to 5 years. So because of this, some sponsors, GPs, might be frustrated and say, we can't wait for 5 years. This is not good for us. I'm not getting anything. I'm working hard and there's nothing. I have to sell. So you don't want to find yourself in that shoe. But if you're looking at it from the bigger picture, you will see that the returns are good. But is it good for you as a sponsor? Is it good for your limited partners? Because remember, you promised them cash flow. Not that you promised, there's really no promise, there's risk. You told them that there's going to be some form of cash flow, and you told them they're going to also have preferred equity. But because of the way you've arranged your capital stack, this has affected your investors' returns. In other words, the idea of a capital stack is for you to properly arrange your deal in such a way that it will be beneficial to you and also to your investors. That is the paramount idea. When you are looking at the surface level of the returns, you also want to check what the cash flow implication is going to look like for your investors and what is it going to look like for you as a GP member. Remember, we are all in this to make money, including your LP and including you. So if you understand capital stack, you'll be able to know how you can arrange it that you will not be over leveraged, one. Because if you look at the last scenario I showed you, the raise was extremely low. The raise for the common equity was about 400 and something thousand. That means you took a lot of leverage from lenders and equity partners, and you raised peanuts. And the consequences of it is that your deal will not be profitable for you, but for them, it will be profitable. So that's the summary of what I have to say today. So capital stack is very, very important. And when you as an LP, when you see a deal, you need to really, really scrutinize it to know how the capital stack is arranged and how it's going to affect you in terms of returns.